You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Monday. I am currently traveling this week, but I thought of you, so I have a full series on The Moose on the Loose this week. An investment roadmap. Why is that? Well, because you know a lot about investing, but sometimes you can feel unsure about where to start, how to invest a lump sum of money. You maybe have like dry powder on the side, and you're not too sure how to start investing. You want to make sure that you make the right decision, that you do not buy the wrong stock or you buy it at the wrong time. You may have questions such as like, how many stocks should I manage, or which stock to buy and when? Do I need investment in all sectors? Do I need investment rules? What are the rules that are more important? What are the metrics that I should focus on? So all of that things will be covered in the investment roadmap that I offer you in this series. And if you want a full guide, actually, I did that for my DSR members not too long ago. Came out with after like several discussions with pro members, and then I realized, you know what? How about creating a step-by-step roadmap where I can help investors follow those steps into their journey into investment so they can have like the perfect like strategy for them, and instead of telling them what to do, like giving them those tools. So you can actually download the roadmap for free. If you're not a member at DSR, I still open this for free at dividendstocksrock.com/roadmap. So one word, roadmap, dividendstocksrock.com/roadmap. All right. So today for day one, we are starting with ground rules. Why it's so important? Because without investment ground rules, you're not gonna go anywhere. Like before, you can think about like selecting stocks, managing portfolios, adding different weight positions. It's way too far. Right now, we have to focus on like what's important for you, what's your goals. So we're gonna talk about that today with some questions. So the first one is, what's your investment focus? Like, what do you want to achieve with that? What's your time horizon? So that's super important, because even if you're 75 today and you're listening to this, I mean, kudos to you. I'm flattered. You still have choices. Maybe you want to invest for the rest of your life. So maybe then your time horizon is a lot shorter, maybe 10 years, 15 at best. Okay, that's fair. But maybe you want to invest for the next generation, or like split your portfolio in two and have like two different strategies. So it's going to help you keep things into perspective. You know, the market correction probably last about 12 months. Bear market will last about 2 years. A big crisis will be like 4 or 5 years. On a 40, 50 years graph, those are like barely blips that you can not even see. So it's just to put your things into perspective. Then what's your investment strategy? And having no strategy, having a combo of like, oh, growth, momentum, income, ETF, index, that's not a strategy. That's like a bunch of like things that you've read about or listened about, and then you just like, yeah, I'm going to put everything into the big mixer. That's not going to work out, right? You need to have a clear strategy in terms of asset allocation, in terms of like USD versus Canadian dollars, in terms of like, what do you want? Do you want to follow the market, be an index investor, generate income, focus on yield, or like me, focus on companies that are super healthy so they can increase their dividend every year? So dividend growth investing as a focus. So for example, on my side, I'm agnostic versus the yield. I don't care if the company pays a 0.5% yield or a 5% yield. I focus on other metrics. And most importantly, the dividend growth metrics is really important for me, because it's an indicator telling me that the business is thriving and will continue to thrive in the future. So that leads us to which metrics will increase your success rate to get closer to your strategy. Even if you focus on yield, for example, well, then key metrics would be payout ratios, long-term debt, ability to the company to at least increase the dividend to maintain and like to match inflation. So those would be key metrics to focus on. On my side, you know me, I focus on the dividend triangle. If you're new to this podcast, I'm going to talk about it throughout the whole series. So Just subscribe to the Moose on the Loose and you'll know more about that. Once you have set your metrics, the other question is how many stocks you want to manage. 5, 50, 100. There are so many different answers to that question. Personally, I think the sweet spot is between 20 to 40. It gives you a good diversification without being super concentrated and like, because if you have like 10 stocks and you're wrong on 3 of them, your portfolio is going to take a big hit. But if you're wrong on 3 stocks out of like 25, it's not that bad, right? Because you cannot be wrong all the time. That is one thing that I've learned a long time ago. Personally, I decided to go with around 35. I mean, I spend my days talking about the market, researching. So following 35 stocks is really easy. Why it's so important to know how many stocks you want to manage is because it's going to help you to determine your target position. So what's your ideal position for a company in your portfolio? So for example, if I say that I want to manage about 35 stocks. If you take 100%, you divide it by 35, you get 2.85%. That's a guideline. So roughly, when I want to invest in a new stock in my portfolio, my target weight will be about 3%. That also helps me to identify companies that may not have an impact in my portfolio or the weight is not aligned with my strategy. If any stocks goes below 2%, well, it needs some love. It needs some capital. I need to increase the position, or I definitely need to review it to understand why this stock is going down or not growing while the rest of my portfolio is performing. Because that's also how you can use that guideline, is to know a little bit more about where you are and where you want to go. So, of course, that's in an ideal world. If I look at my portfolio, I have a lot of like outperforming stocks that are a lot more than 3% for the position. So then you have to determine what's your maximum position that you want to have, maximum weight. Of course, on my side, I've already told you that 10% would be the maximum. So anything between 3 and 10, I will let the winners run. So that's also kind of like a rule. Oh, do you sell after taking profit? Well, it's all relative to the size of the portfolio itself. So if the stock goes from 3% of my portfolio to 5% of my portfolio, this means that the performance was pretty solid, but yet I can live with a stock diving even if it's 5% of my portfolio. It's not going to mean enough for me in terms of loss. If the stock price crashes, I can still live with that. But that's me. Maybe you would say, hey, 5%, Mike, is way too much. I'm going to cap this out to 4%. That's fine. The whole purpose here is to set ground rules. So if your rules is maximum 4% in a stock, that's excellent. The key is just to have those guidelines. So whenever you know that it goes above that percentage, it raises a red flag. Now you know you need to take action, or you need to review your position, you need to review your portfolio. So it's just the whole purpose of following your portfolio using simple metrics, so it's going to be a lot easier. Then which sectors do I understand or I like best? I will have an entire podcast episode on the sectors, but like first things first, it's important to focus on like sectors you understand. Why it's so important? Yes, it could give you like a small edge against the market because you know a little bit more about how like pharmaceuticals are working, for example, but it's not really the point. The point is conviction. If you know the business model by heart and you understand the pros and the cons and you understand like what economic events or what is going to affect and how it's going to affect those company business model, it's going to help you understand why the stock is down. And maybe you're going to just say, yeah, the stock is down, but that's all right. It's normal. I don't mind. I'm going to keep on investing because I understand what's happening. And let's be honest, you saw that this year once again. 22 was another example. 2020 was another example. The stock market doesn't always go up. Sometimes it goes down, so it's normal. But you find it a lot more normal when you have high level of conviction in your stock. So understanding the sectors, like enjoying those sectors, liking them, believing that it's the future, it's going to help you a lot to hold on to those companies. So again, if you want to have the full roadmap, you can download it for free at dividendstocksrock.com/roadmap. If you are members, it's already part of the DSR Fundamental newsletter. It's a good example of like the type of newsletter I write for my members. There are like plenty out of there from time to time. you get lucky, you get one for free as a non-member, but there's a lot more at DSR. So again, dividendstocksrog.com/roadmap to download the investment roadmap. And tomorrow we are going to talk about how to use a stock screener. So we're already getting into the fun part of like creating that buy list. All right, Moose, that's enough for today. Enjoy the sun. And tomorrow we're going to talk again. So until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.